Good morning, ladies and gentlemen. Uh, Welcome to another Boutiques on Wednesdays with BCI. My name is Pierre de Klerk. If you haven't met me before, from Apex Investment Consulting, and I'm standing in for your regular host, Eugene. I'll also be doing it next week, but thereafter he will be back. So I have hosted this a few times before. Today, we are joined by Karabo Matsepi from Balondolozi. Welcome, Karabo. Thanks for joining us. Good to
Thank
see
you,
you.
Pierre.
And to the audience today, we're going to do something slightly different. We're not going to talk markets or stocks per se. We are going to talk a bit more about innovation or portfolio innovation, and specifically portable alpha. So that's what Karabo will be chatting about. We look forward to her presentation. Just a few comments or points maybe about Balondolozi from a corporate point of view, from myself, or from Apex Investment Consulting, as multi-managers and consultants. Balondolozi started about 15 years ago, if I'm correct, and it's been a good experience for us to observe their development and their growth as a business. Over the years, we've periodically interacted with them for DDs, and we certainly stayed close to their development. And like I say, it was a really good experience to see how the business have grown to what it is today. And apart from the investment process and products and so forth that Karabo will cover, from a kind of organizational point of view, I think many of the things that we look for as consultants when we look at asset managers are in place at Balondolozi. So to give you some examples, they have a staff trust with which they share equity in the business with staff. Now, we take a very positive view on that because, what we're looking for is alignment of the business and the investment people with the clients. And we always feel if personnel or senior staff or staff in general have skin in the game, so to say, or equity exposure in their own business, then they are very well aligned with us as investors. So that's a good example. Another example is that they subscribe to the United Nations Principles of Responsible Investment and to the local equivalent of that, CRISA. And that's also important because that shows a seriousness to proper kind of measurement and reporting to clients on their products and their process. And then maybe a third example, which is also particularly important to us, is that they have a very big focus on internal development of their staff, kind of growing their own timber, as people always say. And I think Karabo, I think yourself came through the ranks
Yes.
at the business, and that's also important to our business. I think it's apart from the social responsibility aspect, that also makes it important. It is just good to train people, in your own business, in your process, and in your values and your philosophy. So we take a very positive view on that. So yeah, so I would say Balondolozi, the name might not be familiar to a retail audience necessarily, but you've been around for more than a decade or a decade and a half, and you've made very good, steady progress, maybe mainly in the institutional market, but we look forward to your endeavors into the retail market and rolling your products out a bit more broadly. So thanks again for joining us. You're welcome to share your slides and do your presentation, and then we'll take some questions. And the audience, you're welcome to post questions as always in the Q&A if you want, and we can take those questions as well at the end. Thanks, Karabo. I can see your slides. You're welcome to start when you're ready.
All right. Good morning, everyone. Thank you, Pierre, and the BCI team for the opportunity, as well as everyone who's joined in this morning. As Pierre has mentioned, I am Karabo Matsepe, and I work for Balondolozi Investments. And this morning, I'll just be taking you through our portable alpha strategy. So Just a brief overview of the business. I know Pierre, you've touched on it. So Balondolozi is a quantitative asset manager. We were founded in 2010, and we have just below 16 billion in assets under management. So we combine looking at the hard facts as well as our four-factor model, which provides us with a top-down approach through the macroeconomic analysis. So this gives us an inflation and growth expectation view. And we also have a bottom-up approach through our fundamental, behavioral, and technical analysis. This provides us with a more in-depth view of the assets that we invest in through looking at their financials, such as their balance sheets and income statements, and also checking whether the pricing in the market correlates or is fair enough. We have also over time added ESG as a screen. As Pierre has mentioned, we are a signatory of the UNPRI, as well as subscribe to CRISA, so that it just enables us that we're not only return driven, but we also look at aspects that ensure that we are investing in sustainable and assets that address environmental issues. So at Balondolozi, we have four broad strategies, namely the equities, fixed income, cash, and the multi-asset. And our portable alpha strategy falls under the multi-asset. And we also do have giving back initiatives such as the Alexandra Education Committee, which allows staff to mentor pupils from grade 8 up until grade 12, providing them with career guidance and just a form of mentoring. And then just to touch on our investment philosophy, so we identify and exploit inefficiencies that arise through market irrationality, and these could cause asset prices to deviate from the intrinsic value. This could be due to various factors such as your macroeconomic influences as well as behavioral biases. So where we see opportunity is that we acquire undervalued assets and avoid those overvalued assets in order to derive sustainable returns from them. So just to touch on a macroeconomic tool we used to help us see where value is through our portable alpha strategy. So we look at the performance data across various asset classes, and this is over a tenure of 1 to 10 years. And essentially what we're looking at is the percentage of asset managers that underperform their benchmark. So looking at the South African equities or the S&P benchmark, we can see to my far left there that in the short term, asset managers around 20% underperform their benchmark, and over time, the alpha becomes elusive, and we can see that it increases there in the 10-year period to about just above 80%. And this is a common trend that we have identified through the various asset classes, except for your short-term bonds or enhanced cash strategies. And this could be due to various factors, such as market inefficiencies, making it difficult for asset managers to outperform their benchmarks, or even in situations where you have funds that are tracking the index, you do have certain factors that can influence an underperformance, such as your administrative or rebalancing fees. So where we see the opportunity is to take the strength of your short-term bonds as well, your short-term bonds or the outperformance of your short-term bonds, and put the alpha through those various asset classes. And in essence, what we're trying to achieve is to ensure that capital is invested efficiently while gathering the odds of outperforming through our portable alpha strategy. So just to touch on the Balondolozi portable alpha strategy. So essentially, traditionally what you'd have is that you'd have physical equity to replicate the index. But what we have also identified is that you can use cash plus a future which replicates the index that provides you with the beta component to get your total index return. But Balondolozi has taken it a step further by using an enhanced cash mandate, which allows us to ensure that we don't have idle cash lying around and generate an additional alpha from our enhanced cash mandate by investing in cash and cash equivalents, and also keeping that future to provide us with an index return as well as an alpha on top of that. So we just went further just to illustrate how our global equity fund looks in terms of a snapshot. So we can see there to my far left that we have the Balondolozi Enhanced Cash Portfolio, which has assets generally that you'll find in an enhanced cash strategy, various diversifications in terms of credit links, securitizations, as well as credit. And then we also ensure that the index that we're tracking or the feature that we allocate to the fund tracks the index with that allocation to cash that allows us to service the margins or the requirements of having a future. And that provides us with the index total return as well as an alpha, which is the difference between the yields that the enhanced cash provides us with, as well as the difference, the funding rate. So we'd have a outperformance of around 1.4% there. So the advantage of using a portable alpha strategy in the global equity fund is that it allows us to have those consistent and measured outperformance. So on a month-to-month basis, you'd have around 10 to 20 bips outperformance, and over a 12-month period, we achieve that above 1% outperformance. And this is done through combining the strength of passive investing as we invest in a future. There is low fees, tracking error, and transaction costs, and we combine that with the favorable metrics of a enhanced cash portfolio, which I have mentioned before that in terms of the outperformance, you have a better odds of outperforming in an enhanced cash portfolio compared to your equities strategy. So essentially, the preferred habitat that we want to be is that traditionally, you get asset managers that have the core product, which invests or tracks a passive ETF, and that's where they derive their beta, and then they allocate to asset managers outside on the satellite to provide them with their alpha. So where Balondolozi sees value is using that low risk portable alpha overlay in the core that provides us with the alpha component as well. So you most likely to outperform there by 1% without necessarily changing the risk matrix of the core, as well as providing you with a higher information ratio and then allocating to high value active managers to provide you with the traditional alpha component. So just to touch on the performance matrix. So before I move on to the slide, so as Piers had mentioned that majority of our track record is in institutional clients. So essentially the performance that I'll be showing this morning is of our segregated mandates, which we had the inception of 2021, but we firmly, we employ a similar strategy or the same strategy to our retail clients to ensure that we do get that outperformance, as well as just looking at using those metrics with an inception date of 2021, we can see that for every 100 Rand invested in the Balondolozi global equity fund, you can see that we have been outperforming or in line with the benchmark that we're tracking, as well as we can see that even during times where there was that Russia-Ukraine war, as well as the talks of the Trump tariffs, we can see that the fund has been performing in line or outperforming the benchmark. So looking at our performance, so since inception, we have managed to derive that alpha of above 1%. And over time, we can see that our outperformance is higher than the benchmark. Also looking at our 1 month performance, we did outperform by around 1.25%. And then just to look at our risk return metrics, so we took the Alexandros Forbes survey. Here we just highlighted the benchmark, the global equity fund, comparing it to peers as well as the median. So we can see that we have just a lower volatility compared to the median, with higher returns compared to the benchmark and the median. And the volatility that might come into the fund is mainly due to the timing differences that may arise as the fund is priced by the JSE at around 5 p.m., whereas the pricing from the US comes through around 10 p.m. So you do have that 1 day lag in terms of the pricing. And then just to look at our tracking error and information ratio. So the aim of this fund is to have a low tracking error as well as a high information ratio. So we can see, using the same Alexander Forbes survey compared to a few of our peers and the median highlighted there in red, we can see that the fund offers a low tracking error as well as a high information ratio. And then just to touch on the risk and risk management of the fund. So the features that we select for the fund are used to address concerns such as liquidity, dividend, and pricing. So mainly, essentially, the features that we want to allocate in the fund, we want to ensure that they are actively tradable, as well as target dividend neutral features, as well as ensure that we do receive pricing on these features on a daily. So the features that we have in the fund are listed on the JSE, and the pricing is through Suffix, which allows us to see the gains and losses on a daily period. And then as we use a enhanced cash mandate or strategy to put the alpha, the term to maturity is limited to 5 years, with the duration of the underlying portfolio limited to 365, just to mimic the tenure that you receive in the various features that you allocate in the fund, as well as the credit risk limits are similar to a regular income fund or enhanced cash mandate. So essentially what we want to ensure that we do invest in the big four banks, but also ensure that our credit is not concentrated into one corporate. Also, we ensure that our credit limits are adhered to, similar to what we have in an income fund. And we also ensure that we invest in high investment grade credits, which currently the average credit rating of the fund is AA, just to ensure that we do not invest in low credit just to boost those returns. We ensure that the fund, and we're able to anticipate any risks that may come through in the credit market. And we also ensure that our fixed income exposure is hedged back to the funding currency, which is the South African rand. And that's all from my side. Thank you, Pierre.
Thank you, Karabo. That was interesting. I've got some questions. We've got a bit of time, maybe 10 minutes or so to the end of the session. So I do have some questions that I thought we could cover. And again, audience members also can certainly post questions if they like. The first question, Karabo, or maybe almost not a question per se, but I'm very well aware that most people, or at least some people on the call, might not have heard about portable alpha at all before, or might not even be familiar with futures and exactly how they work. So that's why I prompted you, pre-discussion also to give a bit more detail around that. But maybe let me play it back to you in terms of my kind of simplistic understanding, and then you can maybe say, whether it's the right way of understanding it, or whether there's any kind of enhancing comments to make. So I would say an easy way for people to understand it is that a future is obviously a derivative, and it is a geared instrument, which means it does not consume all the investable money that you have. So if we take an example of having 100 Rand to invest, to get 100 Rand's worth exposure to the MECI ACWI through future, don't tie up your 100 Rand. It only ties up a small bit of it. And in fact, because of the mark to market, you can actually keep the money elsewhere. We'll put it that way. And that elsewhere is then your fixed income fund, where you obviously try and deliver a return higher than what the cost is of kind of financing the future, so to speak. And that difference is really, so it's really the return. I suppose the important point to make is the money sit mainly in your fixed income fund, and that is what generates the return for the alpha. It is really the fixed income return that comes from your fixed income fund that is the alpha that is then ported, as we say in a fancy sense, onto the equity benchmark. Is that the right simplistic way of understanding it?
Yes, that's correct.
Okay.
So basically, in terms of the future, just to add on what you're saying is that essentially we agree on a price, and then we allocate maybe 10% to finance or to keep as a margin requirement, and then the 90% of that 100 Rand will essentially go into our fixed income portion and generates that alpha for us. And the future then just replicates the index and the capital gains as well as the dividends that the index offers. Yes.
Are there any kind of implementation risks around using futures in this way, or what are the things that you need to look out for in terms of how you implement?
There's not necessarily an implementation risk because we basically speak to the banks and the clearinghouse in terms of basically investing in that future. And then mainly the only issues that you need to keep a portion to manage those day-to-day margin requirements in terms of the movement that Safex provides you on a daily basis. Yeah.
So is there, for example, counterparty risk in the future as there is in a credit instrument?
No, there's not necessarily that much counterparty risk. As I mentioned, is that essentially the future is replicates the index in terms of the capital gains and the dividends. And through the suffix, we do get the gains and losses on a daily. So essentially you
Does
allocate
the daily
on a
mark to
daily.
market is your protection
Yes,
effectively?
yes, yes,
Okay.
yes, yes.
Okay, that's quite clear. So it seems to be a very efficient way of implementing, and I mean, those of us that are very familiar with it kind of know that it's so efficient. So if we maybe move on to the results that you delivered, I mean, the results are really, I would say, kind of, very solid. One doesn't necessarily want to use the word spectacular, but you almost want to say spectacular, because I just want to remind the audience that, in the equity space, consistent alpha of 1 to 1.5% is actually very good. If you look at the average manager, we all think of top managers that from time to time deliver, double-digit alphas, but it's also not that consistent. But for the average manager to outperform, as Karaba has shown, is difficult. It's very tough. So a consistent 1.5% alpha might sound low, but it's actually, very solid if you can deliver that on a consistent basis. Now, your information ratio looked as if it was about 0.75. And again, for the audience, information ratio is loosely speaking, a measure of the skill of the manager, in a sense that it takes return and the risk involved in delivering the return into account. and the information ratio of above 0.5%. So information ratio above 0.5 is deemed to be very good. So information ratio of 0.75% is certainly, in the very good space. But, reflecting on that good outcomes that you've had, again, the question would be, are there, what would be the investment risks to a portable alpha strategy? So, what can cause the strategy to deliver negative alpha or no alpha for certain periods of time? What would cause that?
So essentially, the main risk, because we use an enhanced cash portfolio, would be the credit risk. So in terms of the credits, we want to ensure that the instruments that we allocate to the fund are of investment grade or higher, as well as in situations where in the markets you're not necessarily getting paid for the risk that you're taking. The tightening of credit spreads might be an influence in terms of the alpha that you might derive from the enhanced cash portfolio. So the main risk that we do see is the credit risk. We also have those timing differences that I have mentioned, that the JSE prices it at 5 p.m. compared to the US, which is at 10 p.m., which causes that 1 day lag. But yeah, those are the main drivers that may influence your alpha in terms of the investments. Yeah.
Okay, so it'll certainly be the risk related to
Mm-hmm.
the alpha portion itself that
Yes,
might
yes,
cause
yes.
underperformance, and that comes from the fixed income. Okay, I think let's move on to the fixed income space itself, which I know is your space. So you'll be able to talk extensively about that, and just maybe given that credit clearly is where much of the alpha comes from. In this case, maybe just talk a bit more about your fixed income fund and the credit process in that, and the limits and so forth. You've already said it's predominantly big four banks, but maybe talk a bit more about, in totality, how much credit is in the portfolio, what are the limits being imposed, do you have a credit committee, kind of those risk management things.
Okay. So in terms of our credit process, so majorly in fixed income space, we do allocate to the big four banks. That's more a conservative approach. And where we see opportunities, we will invest in your corporates as well as your structured notes. So how we evaluate the credit is that we do have processes in our credit process where we look at our allocation to credit just to see where equity prices are showing where credit spreads should be compared to where spreads are in the market. That's the first tool that we do look at, as well as just evaluating the credits on a individual basis. As I mentioned in our four-factor model, that we do have a fundamental analysis where we do an in-depth look at your balance sheet and ensure or evaluate whether the pricing in the market is sufficient for the risk that you are taking. So in terms of the credit, how we allocate, it does follow a typical fixed income credit limit risk. So we do ensure that we are BN 90 and as well as in our segregated mandates, Reg 28 within our limit. So in terms of those limits per issuer, we do have a limit of around 10 to 15%. And per single instrument, we do have a limit of 2.5 to 5%. And we also just have an ongoing process to evaluate those financial records that come in interim financial records to see whether there significant changes in the credit financials. And that also helps us to identify and mitigate those risks of default. And as well as we do, as I mentioned, use ESG as a tool as an overlay just to provide us with a additional aspects in looking at the various corporates and how they address those ESG requirements. Yeah.
Thanks for that. There's a few audience questions that's come in that I'm grateful for, so we can maybe take them. And the very first one, you've just touched on ESG as part of the credit process as well. The first question from the audience is, how do you approach your ESG screening? Do you employ negative screening, or do you apply a discount rate or premium on, based on credit, not based on ESG?
Okay. So in terms of our ESG screening in the fixed income space, necessarily we don't shy away from credits that are concerned, but we do participate in investor calls as well as any interactions that happen between these credits and the investors. So we don't necessarily do the discounts, but we do ensure that if a corporate is a concern in terms of the ESG, we do maybe limit our exposure to that corporate and actively communicate or actively engage with the various tools that are available. Unlike in your equity markets where you can vote and have proxies, the fixed income space is a bit more tricky in terms of how you can communicate or work together with the corporates. So essentially what we do is mainly limits maybe our exposure, but we do not necessarily totally shy away from allocating to certain credits. Yeah.
Thank you. The next question is a question about the liquidity of your fixed income portfolio in the context of having to fund the margin calls on the future. So I'll just read it verbatim. What percentage of your enhanced cash portfolio is available immediately or within a day, and thus available if there's a margin call on your futures contracts? So yeah, I think it's, in the context that it's a credit or predominantly credit exposed portfolio, what is the liquidity profile, and how do you make sure that you will be able to meet the margin calls at all times?
So, as I mentioned previously, that when we allocate to the futures, we do keep 10% aside for margin requirements as well as any liquidity concerns that may arise immediately. But we also ensure that in our enhanced cash mandates, the instruments that we allocate to the fund are actively tradable in the secondary market, which then in turn allows us to be able to, should we need to liquidate more than what we keep in the margin, we're able to actively trade these instruments in the secondary market with minimal losses to the fund. Yeah.
Quite clear. And then the last audience question is a different one that can make you think of it. It says, hi, Karabo, what are the key developing trends that you have currently identified, and what recent changes to your investments, as opposed to your process they imply, have you made?
Okay, so in terms of our portable alpha strategy, there have been minimal changes because we've seen that the strategy has been working for us over time. But the key developing trends that we have identified is maybe on the alpha generating source, so our enhanced cash mandate, enhanced strategy is that currently in the market, we've been seeing that spreads have been tightening and we are not getting paid for the risk that we are taking. So essentially what we have done or taken is to look at other avenues or different ways of investing the cash in order to generate that alpha source that will still help us outperform by 1%. So necessarily your normal credits are tighter in terms of what we get in the auctions. So we have looked at various other aspects that we can invest in to ensure that we still maintain that alpha source generating from the enhanced cash, but not deviating from investing in investment grade instruments here.
Thank you. That's interesting, because I also wondered before the presentation whether there's something structurally in the South African kind of fixed income market that makes it particularly conducive to this type of portable alpha. And I think the level of our yields is maybe one aspect that comes to mind. If you're in a very low international environment, maybe not as we have currently, but go back 5 or so years, where international rates are exceptionally low, then it's not that conducive. But I think in South Africa, we're lucky that we have kind of the types of yields that make this certainly kind of very plausible. I also just want to kind of mention to the audience or clarify that the portable alpha strategy is obviously agnostic of what the underlying index is that you put it on. So you can port this onto equity, you can port it onto bonds. There's no particular structure impediment as to what you can port the alpha onto. Is that correct?
Yes, yes. For example, we above our global equity mandate, we do have a global bond mandate that we have with BCI as well. That the inception date was late 2024, and that one checks the Bloomberg Global Aggregate Index. Yeah.
Thank you very much. We're pretty much out of time, so I think I'm going to wrap up. I think from our side, thinking about the mandate, we would say that, as Karabo have clearly illustrated, to deliver alpha is actually quite tough for equity managers. It's a high hurdle, and the cost that you pay for active management and whether you get the alpha in exchange for the fee that you pay is another big factor. So many of our clients do employ some variation of a core satellite type approach where you keep at least some part of your portfolio either in a pure passive tracker to pay the lowest possible fee that you can and get the index return. But as Karabo also mentioned, that invariably means you end with something slightly below the average, the index return, because there is some frictions involved even in a purely passive portfolio. So many clients look at these kind of strategies and these kind of products that give you, not something excessive above the index benchmark, but literally just enhance it, so that a part of your portfolio really anchors you to your benchmark and you don't overpay for that. And then you can add to that the difficult part of finding what Karabo mentioned, high quality alpha managers. So let's say good quality or very consistent, equity alpha deliverers. If you can find them and include them in a core satellite, then that makes for a really good portfolio. But yeah, the risk management, or if you think about uncertainty, to find a consistent high tracking error alpha manager in the active space is much more difficult, essentially, and it costs you more than what it is to have a passive call or an enhanced call. And that's why, if you look at it from a risk perspective and even a cost perspective, then it does make sense to use these kind of blended portfolio approaches of passive or enhanced cores with high alpha satellites. There's much academic research that seems to indicate that gives you improved returns. So yeah, thank you very much, Karabo. It was interesting and it's a good introduction to this type of strategy. It's maybe more, it's been around in the institutional space for a long time, I suppose, but retail and doesn't really in a big way been a feature in our retail market. So it's good to see that more and more of those types of products become available also to retail investors. Thank you for your time. Thanks for joining us, and
Thank you for
thanks
the
to the audience for
opportunity.
joining us. And next weekend, next Wednesday, we'll be back for another boutiques on Wednesday, and you're welcome to join us. Enjoy your day. Goodbye.